How you doing? And welcome to the Real Estate Talk with Brahan and Abel. My name is Abel Mansur.
And this is Brahan Khan.
And today's episode, we're going to be talking about real estate and real estate investing. So let's jump right on to it, Brahan. How you doing this morning, man?
Doing well, man. How about you, Abel?
I'm all right, Can't complain, can't. I could complain, but who cares, right?
Yeah.
But, so let's talk about real estate investing. So, are you an investor?
I am.
Okay. So talk about when you're investing in property, what's the first things that you kind of look for when buying property to invest?
When I look for investing in real estate, it's not similar to stocks, right? For real estate, you have to look at the market value and how much you're investing into it. One of the most common things that investors look for is how much are you paying for the property and what's the ARV, after repair value.
Okay.
So let's say you're buying a house at around $200,000, right? And the after repair value is $500,000.
Mm-hmm.
You have to look at exactly how much it's going to cost to fix.
Okay.
But then also when you go to the house, you have to see what are the problems inside the house. A great example is earlier this week in Fort Washington, Maryland, it seemed like a great deal. The asking price was only $100,000. ARV was over 400,000. Seems great, right?
Yeah.
But the foundation was completely gone. So foundation's done. That's a complete tear down and rebuild. That's going to cost a lot of money.
And your return on investment on that is not going to be high if you're essentially building your home from scratch, right?
Exactly.
Yeah.
When you're doing that, you have to go through the city or the county, get permits, and talk to a professional builder, a grade A licensed contractor, and they're going to charge you an arm and a leg to get that done.
So that's more like seasoned investors, right? So people that have done this. Let's talk a little bit about somebody that just wants to get into investing, right? So a person that is looking at property and is like, or buys a property and says, hey, you know what, I want to turn this into an investment property. What's like the best ways that you would go about it? So I'll speak from example, right? So my first property, which I ended up turning into an investment property, is out of state. So I'm a big proponent of buying property out of state. I know you're not, and we'll get into the reasons why. But if somebody's new or young and they're like, you know what, I want to start making residual income through real estate, what's kind of like the first thing that you would advise them or how to go about it?
So if they're new, they're just getting into real estate, I have this 1% rule. And this is if you're looking to buy the property, rehab it, rent it. It's also known as the BRRRR method. Mm-hmm. They call it buy, rent, rehab, refinance. Mm-hmm. The 1% rule comes into effect where if you buy a property, let's go back to the 200,000 example. The rent rate, how much you could rent it out for and get rental income, has to be at least 1%. In this case, if it's 200,000, you have to make sure someone will pay you at least $2,000 per month
in rent
on the property
for it to make sense.
Exactly.
Okay. So for example, I give people advices as far as like, hey, you're a first-time home buyer, try looking into buying a duplex. So if you buy a duplex, you can buy it under an FHA loan. You can buy up to 4 units with an FHA loan, right? There's a lot of incentives for first-time home buyers. If it's a duplex, you can live in one and essentially rent the other, which can end up paying your mortgage. And then after a year, 2 years, you can move out of that. Now you have 2 investment properties. What are some of the steps or what are some of the first things that a person with that kind of fortitude or that kind of idea should start thinking, or how they can go about doing that?
So this is one of the nice parts that a lot of homeowners or future homeowners and investors don't know about. It's one of the best ways to do something known as house hacking. Mm-hmm. If you find any multi-unit properties with 4 units or less, you can take advantage of this known rule through FHA financing, where you only put down 3.5% as a first-time home buyer. You live in one of the units and you rent out the other 3, and you can pretty much live for free if the numbers make sense. Mm-hmm. And after that, you can even move out and you own all of the units, whether it's a duplex, triplex, quadruplex. And guess what? You own all of that.
Okay. So just for our listeners that don't know, right? So FHA loans versus like a conventional loan or a balloon loan or however, why is it the better route to go FHA versus like a conventional loan and pay more? And we can get into deeper in that in later episodes, but just for investing purposes, what is the difference between a conventional loan and an FHA loan?
So full disclosure, I'm not a licensed mortgage loan officer. So always talk to your lender to get more information.
The experts in this.
The experts in this.
We're going to talk about our experiences. So
Correct.
don't take our word for this. This is just what our experience is.
Correct.
Okay.
But conventional loans, they always give you a better deal, because whenever you get an FHA loan, FHA lenders usually have you pay a premium at the closing table. And there are hidden costs for FHA loans, because FHA loans are usually there to help first-time home buyers and usually allow you to have a higher debt-to-income ratio at closing. Conventional loans are used a much higher percentage of the time for first-time home buyers, especially if you have great credit. If you have a credit issue, if your credit is shaky, then you may be able to qualify through an FHA loan, especially if your credit's under 600.
Yeah.
Then lenders will find a way around getting you approved. But if you have an excellent credit, let's say your credit's 800, then the lenders will tell you, hey, go conventional, because your rate's going to be much lower versus an FHA loan.
Versus an FHA loan. So in the investment purposes, I guess if you wanted to get into investing and you don't have much money to initially put down, going the FHA route can bring down those costs, and then the grants that are offered for first-time home buyers and things of that nature, if you're going to live in it, could be a good route to go versus the conventional loan.
Well, it depends. It's case by case. That's a great question, Abel. But the lender really has to take a look at your profile. They have to see how much the property is and your income, the DTI, debt to income ratio, and then they can make the call.
And to make the call, yeah.
And right now there's so many grant programs out there that lenders can give free money, upwards of $10,000, $20,000, $30,000 to take advantage of the grants out there, because that grant money is going to run out sooner or later.
Yeah. And once you start investing, I mean, and I'm speaking from experience, like it gets addictive, right? So once you get through that hurdle of getting your first property, you want to keep getting the next property. How does that go about, like for our listeners, just how does it go about once you get your first property? Is it harder to get that second loan? Do you have to use your first home as a leverage to be able to get into the second home? How do you end up snowballing into a bunch of property?
So this is actually one of the first mistakes I made when I bought my initial property in 2009. When you file your taxes, all you have to do is report that initial property as an investment property. When you have tenants in there, just report those tenants giving you rental income. I didn't do that, and I took advantage saying, oh, I want a bigger tax return. I cheated the system. But if you report those tenants on the initial property as actual tenants in an investment property, then lenders will allow you to buy a second property, and then you can keep increasing the amount of investment properties you have. It's pretty simple.
Yeah. So let's get into where we, I guess, kind of differ the most, right? So I'm a big component in out-of-state buy property, because it tends to be, so I'm currently in Virginia, but I lived in Michigan. So I own property in Michigan. I like buying property in Michigan because it's cheaper. It's a cheaper market, right? But your return on your investment is a lot quicker. So when you buy property at such a low rate for me, and I rent it out for a good substantial amount, and I make 2 to 3% of what the mortgage cost is, it feels like it's a better investment. Now there are some downfalls to that, right? So when you're out of state, you have to hire a property management company, and there's expenses and fees. You can't go see the property as often as you like. You have to kind of rely on the company to take care of that property for you. For that reason, you kind of shy away. You have a rule where it's 20 miles, is it, that you said?
Correct. So I have a rule where I don't want to go further than 20, maybe 25 miles if it's a really great deal, because I want all my investment properties to be driving distance.
Yeah.
Because let's say something crazy happens. I don't want to have to call the property management company to tell me everything, and I deal with the headache, and I'm really concerned, hey, what's going on? Whereas I can just drive nearby. I own property here in Northern Virginia, Alexandria, Springfield, Annandale areas. And if something happens with the tenants, I can just drive by, check out what's going on. I'll give you a great example. There's this property I own in Annandale, and recently I dealt with a major issue because there was a bunch of leaks and the ceiling started falling down. So then I had to contact the insurance company in order to file a claim. So in order to do that, I had to go to the property, communicate with the tenant, and then get pictures, and then file an insurance claim. I got a great payout from the insurance company. Whereas if this was out of state, you could go to the property management company, but they may charge you an additional fee. And in my opinion, they may not be able to maximize your value with the insurance claim.
Okay. So we're in a high market, right? So we're in Northern Virginia, DC, Maryland area, the DMV, they call it. It's a little bit harder to get into the investing game here because the properties cost a lot more. So how are you able to maneuver the cost of a home in this Northern Virginia area to be able to turn it into like investment properties?
So it's just a lot of research and analysis. Every day I do my due diligence by researching deals on the market. If you find a property that a motivated seller wants to sell, they just want to dump the property, then you'll see it on the MLS, believe it or not. People think that you have to look for a FSBO, for sale by owner property, in order to find a deal, or look for something off market. That's not always the case. On the MLS, there are two routes I take. Either I look for a property that's been sitting there on the market for a very long time, and then you can give them a lowball offer. Or I look for a property that was just listed, significantly lower than the market value. And yeah, they'll get 10, 20 offers, but try to make a deal with them on why the seller should take your offer instead of the other offer.
The other offers. So is the biggest reason for you for not wanting to invest in out-of-state properties is just the accessibility, being able to get to the property at will?
Correct. That's one of the main reasons. And as I mentioned earlier, just in case something happens to the property, I gave you the example of my investment in Annandale. There was a leak, and then I want to go check it out myself. Definitely property management companies can help, but I've heard horror stories of property management companies as well. They're taking a percentage rent every month, and then when time comes for their service, they're nowhere to be found.
So I guess I'll speak from my experience. So I have out-of-state property, as you know. I hire a company. They take 10% off the top each month. Whether they do something or don't do nothing, 10%, that's the standard. Now you can negotiate that when you have multiple properties or multiple houses for them to go ahead and manage for you. But a typical standard is they charge you 10%. Now, for me, I like the fact that you got to do your research no matter what, right? So you got to make sure you get the right company, the right people in there. For me, it's nice to kind of see that property in my portfolio, but I only have a talk with the managers of the property probably once a month, and I see that deposit coming in. It's like I don't even think about it. It's just paying off that mortgage, making a little bit off the top. Now they take a little bit off, like 10% of it, but I don't have to worry about that day-to-day activity. I don't have to worry about getting a tenant in there, making sure that they're taking care of the property. I feel and value my time more by just giving them that. And I can't fly out there and every day and check up on it, right? So I'm not totally against out-of-state properties. It is a little bit more work, but in the long run, once you have a good company in there and they're taking care of the things, it's kind of like seamless. And like I said, places like Michigan, St. Louis, Alabama, what's the other places that you can get property for very cheap? Boise. It allows you as an investor to kind of grow your portfolio by getting a property there. Now, I don't advise you to buy that property looking at pictures. If you do decide to go to Michigan, St. Louis, any of those places where you can get property for very cheap, I advise you to actually physically go there, see the property. In my instance, my property in Michigan, I actually lived in it. So I lived in it and I knew the property, and then I went ahead and rented it out when we moved here to Virginia. So I'm a big proponent in just growing your portfolio. So owning property out of state is like something that I advise people to do that are just trying to get into the market, especially if they live in a high volume area.
Have you ever thought about selling your property in Michigan at all? Has that ever crossed your mind?
With the interest rates right now and how I got the interest rates, like hell no. But yes, I mean, eventually I'm gonna let the equity grow as much as I can, right? I haven't had, the house is in good shape. I haven't had to do anything to it. There's a tenant in there. They pay on time. I actually got a Section 8 tenant in there as well. So, again, this area doesn't really have a need. There's a need for Section 8, but in this area, we don't have problems finding renters. We don't have problems because it's career-driven people and that live in this area that are going to rent. There's a high demand for rentals here. But honestly, there's a high demand everywhere in the country, right? But sometimes the income doesn't match up. So in my Michigan property, I have Section 8 tenants in there. The great thing for me for the reason I have a Section 8 tenant in there is the county or the city or however that district does pays a good portion of that rent. So like clockwork, that rent is deposited on time, every time, always consistent. Now you have to do your job to vet those tenants and make sure you get good tenants in there. But the other thing is they have to remain good to remain under Section 8. So they do random checks and random. So you kind of have the city or the county or whichever they're going through kind of making sure that that person is paying their rent, one, taking care of the property, two, not doing things that they're not supposed to be doing. And I'm guaranteed that money coming in. Now in this area, that probably doesn't make sense because you can get somebody that's off of Section 8. But usually those people are not long-term renters. So they'll probably be in there 1 year, 2 years, then you have a higher turnaround. When you have somebody that's under Section 8, they usually live in it 3-4 years, unless, something happens or they lose their voucher or whatever they be. So, and on those areas, I'm not against Section 8. In this area, there's no need for Section 8, but it's a quicker turnaround. You're constantly having to get a new person in there. Yeah.
To your point on Section 8, so as you mentioned in Michigan, Section 8 is common and a lot of people welcome it. But here we have a lot of high income earners in the Northern Virginia area. Mm-hmm. So I don't want to say there's no need for Section 8, but it's not as common as Michigan, right? So here in Northern Virginia, it's just a different market compared to Michigan. Mm-hmm. And that's part of the reason why I don't really go much further than a 20 to 25 mile radius, because you really just have to understand your market. Mm-hmm. Because, I've been living here my entire life pretty much. So I know the market. I know every single area when it goes from Springfield to Alexandria to Burke to Woodbridge to Manassas, all the way to Leesburg, even the DC area. So when you understand the market, you really know what you're dealing with. When you go to the Midwest and you don't really understand what's going on in that market, then you're taking a much higher risk. Mm. And when the risk is much higher, even if you see a property for, let's say, $50,000, seems great, right? If you look at it as $50,000 for sale and the rental income would generate $1,000 to $1,500, that seems like an awesome deal, right? Mm-hmm. But when you don't know the market, the risk, in my opinion, is really high. And I wouldn't want to take a risk like that out of state.
And again, that's, I advise people, so for me, the reason I'm a big advocate of Michigan is because I actually live there, right? Mm-hmm. So I know where the trend is going. I know how the job market and all that. Now, in places like St. Louis and places like Alabama, where I'm looking at other properties, I have to do my research. You have to do your research. You have to see what's the job market there. What's the amount of people that are renting in that area versus people that are buying in that area. It might not make sense to do it as a rental, but you might be able to buy a property for really cheap, put little into it, and then make a good profit on it, right?
Correct, a flip.
Well, it's a flip if that's the road that you want to take it in. So ultimately it becomes, you do have to do your research. You have to make sure you get good property in a good area, in a place that's going to either grow or a place that's already developed and grown. So by all means, don't take my word and say, oh, I'm going to buy a property out of state. I looked at the pictures on Zillow. They look great. It looks good. Well, pictures can be deceiving. If you're going to buy property, go out there, go see it, spend a weekend. So I know a friend of mine who owns property in St. Louis. They go out to St. Louis once a year, twice a year if they have to. They have an agent that they deal with there. When the weekend that they're there, they're looking at 14 different properties. I mean, let's look at this property, let's look at this property, let's look at this property. Then they make their adjustments. I don't ever advise you to just blindly buy property. That's not a good move. But like you said, you're locally, you're more hands-on with it, right? So you're the property manager, you're the maintenance man if you're handy, you're the person that, they call at midnight. Now, eventually, once you get to 20, 30 properties, you're even if you're within 20 miles of that, you're not going to have to deal with that.
No, at that point, then, I'll even locally want to get a property manager. I don't want to deal with the headache.
Mm-hmm.
So that'll be another story.
Yeah. So one tip to give somebody that, and it can be multiple tips, it doesn't have to be one tip, but if you want to get into investing, what do you need to do now? What do you tell people?
So if you want to get into investing and you haven't bought a property before, you have to take advantage as a first-time home buyer and just start looking to buy a property. A lot of people are just living in fear right now. There's a trend going on right now that millennials and the next generation do not want to buy houses anymore. Everyone's living in this mindset that baby boomers, Generation Z, and millennials took over real estate. That's not the case. There's actually a lot of inventory available. If you do your due diligence, do your research, you can actually still find deals. Whether it's a FSBO, for sale by owner, you can look for those deals out there.
Okay.
So you just have to go through the due diligence.
So for me, right, when I first got my first property, and then I turned it into an investment property, at the end, after all my bills and everything is paid, you're not making that much money, right? Yes, the equity is growing because your renter is paying off your mortgage and you're making $200-$300, but don't think you're gonna buy one property and be like, all right, I'm set, I don't have to work anymore, I'm gonna live off of that property. Now, in a sense, yeah, maybe in 5 years that equity will grow and your mortgage is paid, but in order to really scale your business, you have to get multiple properties. You can't, you're not going to be super rich off of just one property unless you own like something that has like 400 or 500 units in it. You have to scale your business. So how would you tell people what's the best way to go with scaling? So let's say they bought their first property, they got their first investment property. What are the next steps that they need to do?
So right now, interest rates are going down. I'm sure a lot of people know the Fed actually just made an announcement yesterday that rates are going to drop.
Yeah.
So this is known as the BRRRR method I was mentioning earlier: buy, rehab, refinance, rent it out. With rates dropping, if you have one property already, you can refinance it and do something known as a cash out refinance. Mm-hmm. Let's say you have one property. You probably grew equity in it already. Let's say your interest rate is 6-7%. When rates drop, you can refinance it, equity's there, take that equity out, use it as a down payment for your second property, and then keep on circling back to this method over and over and over.
So I get you on that. The problem with that, so a lot of the people, or like for me, for example, I'm not willing to give up my 2.5% interest rate, right? So that refinancing doesn't work. So the other step would be like a HELOC, right? So take out that HELOC. Now that doesn't change your interest rate. You still keep that low interest rate, but you can use the equity that you built into buying your next property.
Correct. So there are two methods here. If your interest rate is really low, you have 2.5%, which a lot of people do, then you can take the HELOC, home equity loan or home equity line of credit, and use that as a down payment for your next property. Or if you bought a property in the last 2 years, and 2022 is when the interest rate started spiking up, then you can just do the normal refinance cash out because you most likely got a 5, 6, 7% rate.
Yeah.
And over the next 6 months to a year, trust me, the rates are really going to drop.
Yeah. Now, This one I'm going to give you. All my young people out there that are getting roommates, that are out here paying rent, living with 3-4 different people. If you're interested in getting into the market and being an investor, why don't you take 3 of your friends, right? 3 good friends that you know that are reliable, that are going to be good, buy property, live in that property for a year, grow some equity in that property, take that money out, buy another property, live in that property, rent that other property out, and keep doing that while you're young and while you have the time to be able to invest in all of these properties. A lot of people nowadays, they want to just rent, right? Or they want to get with, they're fresh out of college or fresh out of high school, and they're like, okay, I want to live with my friends and we're going to go get a $3,000 house, when in a sense you're paying that house off for the person that owns it, when you can be going and buying off a home and growing equity, using that equity to continue to flip. And you can do all of this while you're in your 20s. By the time you're 30, you're living off of property that you've invested 10, 15 years ago. Is that something that I think I wish I would have known when I was 16, 17, 18, going into the world, and instead of renting, getting with a group of reliable friends and putting your money together and buying a house and living in that house and then flipping it and then renting it out and growing it, right?
Correct, but it's not too late. What do you want to do it now instead of just thinking about, oh, hey, I should have done this, could have done this? It's better late than never.
That is true.
So just get together with your friends now or someone else and look for the deals now. And so many people, so many investors, what they do is they figure out a way around the system. That's why the government is offering these down payment programs. Even I've helped buyers that have no cash.
Mm-hmm.
Believe it or not, they have no cash. Their credit is decent, and they still manage to find a way to buy a house.
Right.
That's why everyone, they think that, oh, you have to have 800 credit, 700 credit, and have $50,000 or 20% down programs in order to qualify. That's not the case.
Yeah.
If you just do your due diligence, talk to your realtor, then they'll guide you on exactly how you can get it done.
And we'll dig deeper into this next week, when we're actually going to have a mortgage lender here to kind of talk about the ways of doing this, whether it's your first time property, whether you're buying an investment property, whether you're over here and it's your third or fourth property. We're gonna try to dig deeper into that and help you guys out and figure out paths to be able to be in homeowners. I think a lot of the times, especially in our communities, we don't share information. And one of the goals for us here is to share the information. Because when you prosper, we all prosper, right? So grow with us, grow as a community. America's for sale, guys. All these properties, all these things, you can attain them. You just have to be able to work hard, right? Things are not going to happen overnight. You got to be able to work hard. You got to be able to put the time into doing what you want to do. And you got to do your research. If you want to gain these financial freedoms, or you want to gain these goals of being able to take care of your family without having to worry about the next check, you can do that here. That's the one thing that I tell people. This is America. Like, you can do that here. You just have to be willing to put in the work, right?
Well, I don't know about that, Abel. America's not for sale, because even if you own property, you still have to pay taxes. So
I mean, yeah, but taxes. What are the things they say? Like, 2 things that are certain in this world is death and taxes, right?
Death and taxes.
We can't avoid taxes.
We can't avoid it. But one thing that's interesting is so many properties in America don't have loans on them.
Yeah.
There are no loans on these properties, but they still have to pay taxes.
Mm-hmm.
And that's another way you find deals, is by going to the county or the city courthouse and looking for the properties that have a tax bill due and they're not paying the taxes.
Yeah.
So then those will go to tax auctions, and then you can go to the tax auctions. And if a certain point, let's say there's a certain property that has no loan and the tax auction builds up, right? The tax bill builds up. It'll go to tax auction. Then you can join the tax auction and claim the property.
So I'm assuming in this area, I haven't gone to a tax auction just yet, but I'm assuming when properties like that go up, the competition is fierce, right? It's
Correct.
a lot of people. So for our listeners that are like, oh, that's interesting, I want to do this. Can they do that if they don't live in the state either? Or is that only
It can be out of state. Every state is different. There are two things. One is known as a tax lien and one is known as a tax deed.
Mm-hmm.
So what you have to do as an investor is you have to purchase these tax liens and tax deeds. So let's say, my property, for example. Let's say I have no loan and then I stop paying the tax bill, right? You can purchase the tax lien or tax deed by covering the taxes. And then the county or the city is going to continue to communicate with me saying I have a limited time to cover the bill that you paid, and you're earning interest off of the bill that you paid. And if I don't pay it by a certain deadline, then you claim the property.
Okay. So another one is when you own property, and let's say you have a substantial amount of land and you want to build on that land to be able to, let's say, build a back house or a duplex in the back of it, or add on another floor to do that. How do you go about that? Is a lot of it is county and state that you have to go through, right?
You have to go through the county. So let's say you own a single family house, a duplex, that's the only property on the land. You have to go to the city or county courthouse and go to the real estate division. And they're going to have certain forms you have to fill out in order to get the permit approved. And if if it's something simple like windows, it's not much changing the windows. But if you're adding a level, then they're going to send an inspector from the city or county division.
Go and verify
And inspect it.
One thing I noticed that I know or I see here is that, right? So I'll be driving down in some part of the area and then I'll see this lavish home. Mm-hmm. And then right next to it is like this 2-bedroom shack. So I've noticed a lot of the changes that are happening here in the Northern Virginia area as well.
So that happens a lot in certain areas. In McLean, you'll notice that. In Fairfax, you'll notice that. And this is one of the common knowledges of real estate, right? If you see $1 million house and right next to it, you see a beat up shack, that shack is worth at least $600,000, $700,000 just because of the land. And if you buy it, you tear it down and build on it, you can easily resell it for well over $1 million.
Well over $1 million. That's crazy. I mean, in this area, just the property values, sometimes people fail to realize it. And I think people do realize it now, but it's just like as competitive as New York or LA would be. Like people wouldn't think like, oh, you live in Northern Virginia? Like they feel like, oh, that house, I have a lot of clients that are out of state, right? And they're looking at investment property and they're thinking, oh, Virginia, I should be able to get something real cheap. And when I tell them the prices, they're like, oh, I did not know that this was such a high value area. I'm like, well, I mean, you have the federal government here. You have, job security here. This area is a hybrid area that is going to continue to grow, in my opinion. But
correct,
people are going to go further south and further, which brings me to this is away from your 20-mile rule, but a lot of people are looking into Baltimore and thinking Baltimore is going to be, the next area to invest in. And I'm all for that. I'm actively looking for property in Baltimore. What's one reason why you don't like even entertaining Baltimore besides the distance?
So the distance is one, but the other issue is it may take 1 to 2 generations for Baltimore to change, in my opinion. Mm-hmm. And I think more short term, especially for flips and even investments for renting, I think over the next 3 to 5 years. I'm not thinking a generation ahead. I think it's going to take a full generation, at least 1 to 2 generations for Baltimore to finally change.
And be in the up and up, right? So
correct.
I look at Baltimore and this is for anybody that's interested, do your research again. I look at Baltimore as the next coming of DC. And the reason I say that is if you look in history has a way of it repeating itself and history has a way of teaching us things, right? So if you look at DC and how DC had those board up houses in the 80s and what DC is now, and I mean, you can attest to this, how much property values have skyrocketed in DC in areas that you're like, I'm not going to pay $1.2 million for this, but they have. I do feel that Baltimore is going to be that next DC kind of growth.
I agree with you, Abel, but that took about, so we're talking the 80s.
80s,
and that took
40 years.
Yeah, for 40 years. So I don't want to invest in Baltimore and wait 40 years. You know, if I wanted to invest in something, I just put my money in Microsoft, Google, you know, other big companies and let it sit there for 40 years. That's a much better return, right?
Yeah, exactly.
So that's why I don't want to take that risk with Baltimore at this point.
It would definitely. Again, I'm doing more research and just trying to figure out. A lot of people have been coming to me and telling me like, hey, you can buy a house in Baltimore for $1. And I'm like, yeah, but you have to see what kind of house it is, and there's stipulations. You got to get it built. So the city of Baltimore is really doing a lot to kind of help grow and revive that area. I do think it would in the future, and it's a growing area, and it's a place for people to look into. I'm not going to tell you to go ahead and invest in it. I don't want to have to compete against you in it, but look into it. It's going to grow. And just look into property ownership, and whether it's out of state, whether it's in state, try to get into the market. Try to figure out ways to grow your portfolio. And once your portfolio grows, look at areas where you can improve on that. One of the easiest and fastest ways to do it is property growth.
Correct. So another great way for investors to look into properties, so especially for investments, is making a great connection with divorce attorneys. So let's say you connect with divorce lawyers, you know, a couple, they're not getting along, all of a sudden they have to separate their ways. Divorce attorneys will link up with you, and they'll help you get a property that will go less than market value. Because, you know, when a couple goes through divorce, what usually happens? Things don't work out. Husband usually moves out, or wife usually moves out and rents an apartment, and then they aren't working things out well. Then they have to usually sell the house at less than market value just to dump it. And there are usually liens placed on the property too. Mm-hmm. So a divorce attorney, they usually have a set of agents or investors they communicate with.
Communicate and reach out with that.
Correct. So if you make a great connection with the divorce attorney, you can get a great deal.
That is very true. There's a lot of off-market deals that are happening that you just have to put yourself in there and try to find those properties. And once you find those properties, things will work out. Then the rest is just negotiating. It's figuring out who and where to build the relationship. Again, real estate is always a networking thing, right? So it doesn't matter how much information that you have about something, that helps. But at the end of the day, if you don't have the network of people to get that to, or you don't have the network to let you know about these deals, it's not going to take you far. You got to get out there and network yourself. Actually, my wife and I were talking about that yesterday, when it was just like, okay, I'm from Los Angeles and my network is extensive in Los Angeles, but it has to grow here.
Correct.
And in order to do that, you have to get out there, meet people, talk about ideas, go to conventions, go to seminars, whatever the case may be. But if you're really looking into investing, you have to put yourself out there. You have to put it and just bluntly, man, talk to people, get around people, start brainstorming with, and you got to do the work.
Correct. And sometimes when you have motivated sellers, as you said, talking to people, motivated sellers, they come to a certain point where they just want to dump their property and they need the cash quick, right? Mm-hmm. So let's say they acquired the property from their parents. They don't feel like going through a realtor and they just want to dump it, right? It's your neighbor. They just got the property and, you see there's something wrong with the house. Just knock on the door. Can't hurt. You miss 100% of the shots you don't take, right?
Yeah.
So just communicate with them. So after you find something out, maybe you can make a deal with them and they'll sell it to you $100,000, $200,000 below the market value. And maybe he just needs a paint job and new flooring.
Yeah.
You never know until you try.
So let's dig deeper into that, right? So let's say you buy your property. How do you go about, for our listeners, and just to let them understand for you, how do you go about finding the right contractor, the right person to work on this and negotiating those deals so that they can get the house running and be ready to flip it? So if you're on the flipping side of it, right? So you're like, you know what, Abel, I'm not interested in renting. I want to buy property, fix it up, sell it, move on to the next. How do you navigate finding the right agents, finding the right contractors to be able to do those things for you?
So I would always look for referrals. Talk to your friends, families, on contractors they've worked with that have done a great job, because you want to see their history, right? If they haven't done a great job for other people you know, then you don't know if they'll do a great job for you. Because once they start on the project, go through the demolition if it's a bigger project, start painting, start putting in new floors, or if they work on the HVAC, the furnace, the water heater, even as far as the roof, you don't know how big the project is. But if they start on it and they do a lousy job, I've experienced this before, and they're halfway through the project and you regret it and you already paid them, you're going to be in for a lousy week, you know, because then midway through the job, you have to terminate the contract with the contractor, look for someone else. The expense is going to be much larger than anticipated, and you're going to be in for a headache.
So for you have those numbers in mind before you even make an offer on a property.
Correct. I use a formula. I take the after repair value, what the market value is similar to comparables in the neighborhood. Then I multiply that by 80%. Then I subtract the repairs. That's how I usually come up with the offer.
Okay. And then in contractors, it's always negotiable with contractors too. So
correct.
If one person gives you this number and the next person gives you that number, but you know this person does better work, you can always negotiate it. It's just like in buying property, just like everything is negotiable. There's nothing that's set in stone, right?
You know what's funny about contractors? I've noticed they're seasonal. So in the winter, they charge less versus the summer because they have more demand.
More demand, yeah.
But it's case by case too. So for example, if contractor A has a lot in his pipeline for work, contractor B, even in the summer where it's been more busy, right? Like right now, doesn't have much in his pipeline, he's going to charge you less than contractor A. So it pretty much depends on how much work they need. Then they'll charge you less. But again, as I said earlier, really check their references to make sure they do a great job.
Yeah.
Because you don't want to get someone in. I've had a terrible experience before. Someone comes in, they have a shit show. They do a terrible job, right? Then you're stuck with stress. You have a headache. They're halfway done. You have to get someone else in to fix their lousy, sloppy job and pay more in the end.
And don't cut corners.
Yeah.
Don't try to save a couple $100 here and a couple $100 there because you want to maximize your profit. At the end, if get a licensed contractor, get somebody that you can, if something goes wrong, you can sue them.
Yeah.
You can take them to court, right? I think a lot of people try to just cut corners and save as much as they can. But in that aspect, they give up a lot of quality and a lot of workmanship.
And to your point on that, Abel, whenever I work on flips, I think of for the future homeowner, you know, whether I represent them or they have another agent, it's regardless of that matter. The point is, I think of, okay, I want them to live here and I want to be at peace because I don't want to have to deal with, okay, will they have this issue with the toilet? Will they have this issue with the kitchen? Will they have a roof leak in the next year, right? Even though legally when you're working on a resale, you don't have to give them a warranty. Mm-hmm. This isn't a new build, right? Yeah. Whenever you're working on repairing and working on a flip, you just want to go in with a good heart and make sure that everything is taken care of and you're doing things the right way with a good conscience. You don't want to screw them. And as you said earlier, cut corners.
Yeah. And a lot of people that are out there that are doing a lot of the work themselves, yourself, right? So the people that thrive on sweat equity, which is great. If you're handy and you know how to do that, just make sure you get the permits to do some of the
Correct.
stuff. The reason we say that, for me, it's when you have the permit, you have the backing behind the county, the state, whoever you go through for your permits. Get those permits so that when you go to sell the house, you can say, hey, I rebuilt the roof or I rebuilt the basement. These are the permits that allowed it. And because now you're holding the county accountable, right?
Investment and you're flipping the property, you have to get permits. I've dealt with investors before in DC, and DC is strict, especially compared to Virginia. where they tried cheating the system and they wanted to go around getting permits. And they really got hurt in the end, because then they got something known as a stop work order. And then they had to go around the system, and that stop work order lasted about 8 to 10 months. And they lost so much money by having to still pay taxes and waiting before they can sell the property. So if you just follow the rules, then you can still be profitable. But if you try to skip getting a permit and skip cutting corners, right, you're not doing things the right way, and you get hurt in the end.
Yep, exactly. I'm a big proponent, and if you do things the right way, of course, there's going to be roadblocks and things that happen, but at least you have the backing behind it, versus if you try to cut some corner to save on this corner, it's going to end up biting you in the end, right?
Correct. Do you remember when we were in school, and then, we always had to study for the big test?
Yeah.
What happened to everyone that tried to cheat and not study, and then the exam day came? They ended up failing, right? There's no secret in the real world either. If you do things the right way and you don't skip and cut corners or, try to avoid getting the permit, then you'll get in trouble. You have to get the permits. You have to do everything the right way, not cut corners. And then you can be successful in flipping properties.
Yeah. Whether you're trying to get into some properties to rent, whether you're trying to get into properties to flip them, go about them in the correct manner, and they'll end up benefiting you in the long run, right? So
correct.
Just to circle it back to going into this investment world, going into the new world, you think it's a good time to start investing at this time, or next year, or people that are trying to buy properties, should they wait to start buying these properties?
So as I mentioned earlier, in regards to contractors not having as much work in the winter, it's funny because the winter is when everyone wants to go on vacation. We're approaching the end of August, school's starting, and the Thanksgiving, the Christmas season is when we don't have a lot of buyers. Seasoned investors hit the market because properties are actually lower. It's funny because I talked to an appraiser about a year ago who has 30 years of experience. And when appraisers, they go to properties and then work on their reports, he told me that when an appraisal is done in the fall or the winter, then they intentionally mark up the appraisal value.
Yeah.
But when it's done in the spring or the summer, they downgrade the appraisal value. And he told me because there are more buyers in the spring and the summer versus the fall or the winter. Right now, because there are less buyers in the market, it's a better time to buy. And ironically, now is when the Fed is lowering the rates. The Fed made the statement yesterday, the rates are going to start trickling down between now into 2025.
Yeah.
So it's the perfect time to buy an investment and then start working on it, because it could take anywhere from 3 to 6 to 9 months, depending on the severity of the property, to flip it. And if you put it on the market, the property on the market by 2025, then you can sell it and make a good profit margin.
That is correct. Well, on that note, we're going to end today's show. If anybody that's out there that's looking for property to invest in or wants to learn more about investing in property and how to go about that, hit us up, man. Send us a DM, ask us some questions, and we can